Hello and welcome to Fireside with the VC. My name is Andrew Romans, and today we're sitting with Mike Smerklo, who's the co-founder of Austin-based venture capital firm Next Coast Ventures. By the way, the first time I heard that, I thought, what a dope name for a VC fund. I think it's a super cool name. We're going to get into what's behind the name, but before becoming a VC, Mike, I think he started off in the famous sweatshop of Lehman Brothers. And then for those that understand the difference between the different bulge bracket places, I think that was the one with the highest temperature, the most sweat, and the hardest working conditions.
Yeah.
And I was sad to see them go along with the volcano or whatever happened back then.
Yeah.
But then moved on into the world of entrepreneurship. I believe bought a company with 30 employees, grew it to 300 million top line revenue, IPO'd at nearly $1 billion valuation, which for people as old as us, that was like the winner's circle as opposed to a pre-money valuation for some guy investing right before the bubble bursts.
Yeah.
But and then he's actually a published author, so we'll have to offline commiserate about the good and the bad of writing books and how to do all of that. His co-founder was at AV, Austin Ventures. At one point, all the VCs on my VC panel after the demise of AV were ex-AV, so that's good. And I guess it's a 2015 vintage was Fund One.
Yes. Sir.
But you know, if you're going back to AV days and all that, and you must have been on the other side of the table with a lot of V's, this is not new stuff for you. But Mike is author of Mr. Monkey and Me, which was published in late 2020. So I want to make sure we have time to dive into that. But before we get started, a quick tutorial on venture debt from my buddy, Mark.
Hi, everybody. This is Marc Andreessen. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnering with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things and we'll see you on the other side.
Thanks, Mark. And anybody who needs an introduction, happy to share your information with them. Just get in touch with me and I'll put you in touch with Mark. Thanks so much for supporting and sponsoring the pod. Okay, Mike, thanks so much for spending time with us. Can't wait to get into Next Coast Ventures and your book and everything.
Yeah, thanks, Andrew. Great to be here.
Hey, so why don't you give us a quick background on yourself? I mean, I gave the quick bullet point journey, but you know, tell me about your background in getting to venture capital and maybe even how that got into Mr. Monkey and Me, and tell us what that is.
Yeah, you know, kind of, I think that you and I probably got here the old way, if you will, in terms of venture. Quick background, I was the first person in my family to ever go to college. Grew up in Toledo, Ohio, very humble roots, which ties back to the book. As you said, I got my first couple of jobs were in the finance. I started off as a CPA of all things, walked in day one. Holy cow, what have I done wrong with my life? You know, at 22, but did that for a couple of years. Then did get a job with Lehman. It was the ultimate sweatshop. I learned
was that New York or where were you?
I was in Chicago, actually. So
Chicago, okay.
In Chicago. I was doing M&A in Chicago for the least known firm in Chicago. So learned some very good selling skills, but we were like selling fertilizer companies and, you know, really gritty M&A stuff. Went to Northwestern for the business school and then decided I wanted to get part of the entrepreneurial community. So I moved out to California, late 90s, and jumped right in.
And weren't you with Morgan Stanley for a time?
I did.
So like .com madness days or?
Yeah, I went out right in the late 90s, and it was full on bubble, the bubble, whatever bubbles go. And it was great. I mean, I literally got to work with some amazing founders. It was the wild, wild west for any of the, not just the bro culture, but it was just crazy. I mean, things were being created on the .com, on the infrastructure. The entire modern web that we have today was being built
Yeah.
by some very colorful characters. So I worked there, and then I got approached by Marc Andreessen and Ben Horowitz to go join a company called LoudCloud, which Ben has memorialized in The Hard Thing About the Hard Things, one of the greatest business books in my mind. But I was out helping Marc think about raising capital. He said, I got a better idea. Why don't you come join us? And so I went from khaki pants and loafers and striped shirts to a warehouse in Sunnyvale, California. Like, holy blank, what have I done, working for those two guys and that team, those four founders, very early days. So I got to see that go from height of give the hottest startup in the Valley, IPO'd barely in 2001, and then 9/11 happened.
So was that one of those? I mean, I lost $300 million at that time, where you don't survive the lockup. Were you a didn't survive the lockup guy, or?
I mean, by the time that company went public, it was it might have been the last company out the door in the IPO window in 2001. And the only reason it actually went public is because of Marc and Ben, but really Marc. And so we squeezed out, and the stock traded horribly down. So I was never really up. Let's put it that way. My joke is, yeah. When I went there, I thought I was going to buy a second house. Midway through, I thought maybe I'll buy a new car. And when I left, I think I bought a mountain bike. It was that kind of economic journey personally. But yeah, it was an amazing experience. In retrospect, I literally got to go, if you're going to go take a operating job for the first time, what better way to jump in with two amazing entrepreneurs in the height of a boom to bust cycle. Holy cow, 24 months of craziness.
Yeah, I mean, I think it's good to have that muscle memory buried in you when you're guiding founders through cash raising, cash spending decisions, hiring, all that stuff. Do you remember, because at Morgan, during that was kind of like Frank Quattrone days, were IPOs that went out on the NASDAQ doing 18-month lockups? We had an 18-month lockup, which now just feels like an eternity. Like, how many wars are we going to have in 18 months? It's like,
12 to 18 months. And the other thing that was interesting, Andrew, if you remember back at that time, which is very different now, it was a negative if the founder had taken any liquidity off or sold in the IPO. So the founder,
Marc Andreessen is famous for doing that, right? Like when Netscape had the IPO, with what's the Silicon Graphics guy's name? I can't believe
it was Clark and Barksdale with Jim Clark.
Yeah. So, I mean, I remember in the press, everyone was very upset with Marc Andreessen for selling a massive block in the first week of, listing of Netscape. And he's like, hey, man, my dad made me do it. And I was like, God bless Marc Andreessen's father. That is like in my first book on the M&A chapter, my, inspiring quote is, I made most of my money selling too early, JP Morgan. And, so it's written by, JP Morgan apparently said, well, I made most of my money selling too early. And I'll tell you, there's not more wisdom in a sentence than that. Like, so, and Marc Andreessen's done perfectly fine of having sold some of his Netscape shares before the crash of the .com. Come on.
Yeah. So, I mean, it was just, and it's a crazy time, right? I mean, oddly enough, as you get older, you go, wow, a lot of the things we're seeing in the venture community now, and if this is being recorded in 2023, same thing happened 20 years ago or 22 years ago. But yeah, so I came through that. I wanted to be an entrepreneur. The only problem is I didn't have a great idea. So I found this thing called the search fund, which wealthy guys give you a little bit of money to go find a company to buy. I found myself in a crappy airport outside of San Francisco International Airport. Thinking 2 years ago I was working on Wall Street. A year ago I was flying on Marc Andreessen's private jet, and now I'm cold calling, people, trying to get them to sell me their business, and they're hanging up on me. So it definitely had a following, like, what the F have I done with my life? But I got lucky. I found a great business to buy, a tech-enabled services company. I raised capital. I bought that with a firm called Houstonic Partners. Then Benchmark came in and
Oh,
invested
wow.
in the business. Bruce Dunleavy, one of the founders, joined my board. General Atlantic in 2008.
Oh, wow.
Then we took it public in 2011, and I ran it for 3.5 years as a public company. By the end, as you mentioned, a couple million to 300 million, 3,000 employees around the world. A really amazing entrepreneurial experience, and one that was, quite lucrative for my investors, and pretty good for me as well.
Oh, it's
Then I moved to
fantastic.
Austin in 16 to start Next Coast Ventures, as you mentioned, with Tom Ball, a longtime friend.
Okay,
And
so
former Austin Ventures guy.
so you're like a transplant like
Yeah.
me. I mean, I've been coming to Austin my whole career because I've had Austin-based, startups I was working with, but I moved in January 2021. So 2016, I mean, you did well in real estate. I mean,
Yeah. It was a good time to move here.
Yeah, that was a good time to be getting a good house and leaving the lovely tax environment of California and everything else you got going over there.
Yeah.
So tell us quickly about Mr. Monkey. I want Mr. Monkey and Me. That's the title of your book. Published November of 2017. When did you really start that book? Or is that you've been writing that book since high school, or?
No. I think it was published in 20. Actually, in 20. Yeah, it was right after I remember it was because right after Trump lost to Biden. I'll tell you, there's a funny story about the cover, but So basically, after I left ServiceSource and I starting Next Coast Ventures, I always enjoyed writing, but I really wrote it because I found a pretty big void in content that I saw for entrepreneurs. I saw on the one hand, there's the how do you write a business plan, and actually, I mean, your books are great about like some of the how do you think about venture capital, how do you think about M&A, and wonderful content there. The other one was what I called entrepreneur porn, which was, I started this business 2 years ago and now I'm Mark Zuckerberg. Certainly
It's a victory lap book. It doesn't help anybody. It's just like, show me the actionable content. I wake up, I put my trousers on, and make $1 billion.
Yeah,
that doesn't help anybody.
Mark,
maybe inspire someone to go in the industry. I don't know.
Well, I think what it did, Andrew, is I think it gave a lot of false positives to entrepreneurs. Like, hey, this should be easy. This shouldn't take that long. And nothing I found in the market was addressing the mental aspect of entrepreneurship. And so I looked at my own career as an entrepreneur. I looked at what I saw from Mark and Ben, and then I interviewed some of my really dear friends who have been much, much more successful than I am, and said, what were the mental aspects that you most would call out in yourself or others about successful entrepreneurship? And that's what it is. This is not a book of, my joke, if this was the Mike Smerklo story, it would be like a 1.5-page blog post. This is really about the mental aspect of entrepreneurship. And the real star of it is why the title was a kind of caricature, if you will, of a monkey. That was my alter ego telling me I couldn't do it, I wasn't going to be successful. And the whole book, obviously it's a play and hopefully a light read, but really trying to get entrepreneurs to understand you're always going to have this voice. It's never going to go away. So how do you offset that and start thinking about mental tenacity to really get through all the ups and downs that so well as anyone who's been through the journey understands.
Yeah, I mean, I've been since I wrote my first book, I've been keeping an outline of things for a fourth book, and I like wait for things to happen. And so like something happens, I'm like, is that good enough to go in the book or not? And you learn you got to keep it down to 200 pages. Like if you just write a book, it'll be like 900 pages. So you got to keep it down to 200. And there's one of like about like nuclear options versus chemical weapons, and like when things are going really, really bad. And I even talk about suicide because I've got a bunch of people who have taken their own lives, that I was dealing with, during or before or after, or during or before, So I think your book is really important. I'm going to definitely pick up a copy. I'll put a link in the show notes for that, just because it's certainly it was easy for somebody, but it's not easy for most people. That's for sure. So why don't we?
Thank you. And I'll make one thing I will call out for the listeners is all proceeds go to charity. I set up a scholarship for diverse and underrepresented entrepreneurs who are interested in entrepreneurship. So all the money goes to that. My PR folks are always like, don't forget to say that. So sorry, I want to throw it in there.
No. I saw that. And that is nice. I'd like to see you. How about you keep all the royalties from the book, and then you do 10% of your you're carry to charity. Like, you know, you were a CPA, so you're too smart for that.
You're a published author, so you know that you know the economics of book publishing. So
I like the
yeah.
foreign book rights. I'm in 6 languages. I thought that worked pretty well. You know,
Did it
I've got
really?
nothing
Okay,
great to say about McGraw-Hill, but I'll talk to you about maybe I should use it. Anyway, let's not get distracted on all my
sorry, yeah.
experiences and knowledges about books and publishers and all those deals. So Next Coast Ventures, I love the name, and the name says a bit about what you guys are up to. So why don't you give us the framework of what makes the firm different, and for people to understand when to show you deal flow.
Yeah, so we set up our mantra is built by entrepreneurs for entrepreneurs, and that really was a model we saw. Tom had been an entrepreneur before he joined Austin Ventures. We wanted to come to Central Texas, invest in the next coast. We thought there was an entrepreneurial movement happening, not just in Austin, but similar markets, but Austin's a great place to do this. And our ethos and every person on our investment team has actually built and run a business. So we've sweated payroll, we've laid awake at night, 4 a.m, wondering how we were going to survive. We've done layoffs, we've done all that stuff. And I don't know if that makes us better or worse investors. I think what it does help us at the board level is have a little more contextual reference. It helps us we say to entrepreneurs, hey, it's your bus, you're driving the bus. We're just going to try and help you on both sides of it, the good and the bad, and have a frame of reference, which perhaps is different because we've actually done the job. In terms of what we look for, we tend to invest in enterprise software, consumer, and emerging platforms. Those are our 3 kind of broad enough to drive a truck through verticals. And Series A, Series B, take lead investments, join boards, don't do a lot of seed. We tend to do a little more pragmatic technology, meaning we underwrite things to a pretty realistic outcome. If it's super technical, way cutting edge, or a massive burn company, for example, we didn't do anything in Web3 or crypto, thankfully now, but it just, we look for areas that we know really well, relatively small firm, about 600 million of AUM. So we're looking for things where we can write a $5 to $15 million check, roll up our sleeves and help. If it's on, other end of the spectrum, we're going to pass pretty quickly and let you get back to focusing on the day job.
And so you said 5 to 15, is that what you said?
Yeah, 5 to 15 is a sweet spot.
And if you're doing 5, does that mean it's a 10 million round, or does that mean it's a 5 million round?
Usually it's 5, or maybe it's if there's a syndicate. We're usually not the first money in. We're typically following a seed fund or an angel round. So I would say if it's a $5 million round, we're putting in 5, and maybe the rest of the previous syndicates doing a couple $1 million. But yeah, it's the round size would be in the 5 to 7, all the way up to maybe 15 to 20. But we're writing the majority of that check.
And it's late January 2023 as we're having this conversation. What is typically top line revenue look like for a company that is going to land a $5 million round versus a $15 million round in today's market?
Today's market, I would say, we're not paying value prices. We never did. That's been one I think why our fund performance, we're in our 3rd fund. Touch wood, even with the craziness, look to be pretty strong performing funds, but we underwrite things to a very different outcome. But to answer your question, I would say for a $5 million fund, it's going to be somewhere past ideation. We rarely do just pure ideation, but it's going to be ideation to maybe $1 million of ARR. I think if we're getting more into the 12 to 15 million, it's usually going to be, a year or 2 past that. So maybe it's 3 to 4 million of ARR. What we're trying to do, though, Andrew, is we're really trying to come in and say, we're going to help you with go-to-market. We're going to help you with org build-out and KPI and a little more efficiency on the business. So we feel like we're really good when you've got some product market fit, but haven't optimized any part of your business, and feel like our job is to do that for a good 3 to 4 years, and then typically followed on by growth equity or larger funds.
Yeah, and you've spent, like me, most of your days in Silicon Valley. I thought the name meant that we do not, and I thought I saw it on your website, like we do not invest in New York or the Valley, and we're looking for the middle part geographically. But I mean, with all your network, can you say no to these deals that come to you from like Marc Andreessen and?
Yeah, I would say, like, yes, the first part of it's true. It's generally spoken Next Coast. when we've done things on the coast, and we've done a couple in New York and a couple in the Valley, it's been absolutely network led. Like you have a lot of friends in the community, and so if someone calls you up and said, "Great opportunity to be part of this," and that's usually going to be on something we know or have some experience on, we'll participate. But yeah, 90% of the work and capital is going to go into next coast markets. The primary one being Austin. So there's so much good stuff going on right now.
I mean, there's no question that there are stupid valuations in New York and the Valley. And I just, I'm a spectator watching people I know invest at 125 million pre for so-and-so's new company with no revenue and looks awfully hard, But sometimes I think in the emerging market or more provincial, startup ecosystem, that the valuations can be even higher. You got people that are fenced in that can only invest in Ohio or something. And the guy who sold his last company to Cisco comes along and he, and he raises a huge valuation, where in the Valley, like I even fault New York for doing this. Like New York optimizes for dilution. Like, so a company with 10 million with a certain, they might raise 50 on 200. So they've got a 250 million post. The latest investors aren't going to accept, and they'll block anything below a 4x. So you need $1 billion outcome for it to happen. Whereas that same company in the Valley might have done 10 on 40, 50 million post. You sit down with your Frank Quattrone or you when you're at Morgan, and the list of buyers you're going to approach is huge. Whereas how many people are ready to buy that thing for more than YouTube sold for or whatever, or more than AdMob? Like, more than AdMob, And that was considered,
I think you're right.
50 was big.
I think that I think you're going to have a kind of a walking class of zombies. My son's watching The Walking Dead, which is a horrible show, but like,
oh my God, my kid's got a poster of that and it's seen like a gazillion episodes. If he had been preparing for the SAT, he'd be getting a perfect score.
I have the same son. And it's so funny because I'm like, how many seasons are there? He's like, there's like 14 seasons.
I know, he's on season 14. It's crazy.
Yeah, they just keep coming. But I think there's going to be a group of companies that have raised a bunch of money that have gotten to, call it 20 to 50 million of ARR. And all those expectations are there. No one's going to buy them. And, we talk to founders. Having been a founder and gone through it, listen, I want you to avoid dilution, right? I'm not asking you to sell for below market, but I think pragmatism, understanding, to your point, like when my company went public, Michael Grimes, the Morgan Stanley guy, which is my former boss, took us public. We thought we priced that in 11. It was supposed to price around 600-700, which was a huge outcome. And it traded up to at one point above $1 billion. And we were literally like, we probably had a couple $100 million of revenue. Like, holy cow, we're $1 billion business. It was crazy. And then, it settled in there. So it traded pretty well. But that was an amazing outcome. And it was so damn hard. And what I try and convey to entrepreneurs is it's going to be a really hard journey. And I think right now, you got a bunch of entrepreneurs that raised way too high. They're burning way too much capital. And now they're going through this painful process. Everything has to be reset. So if you can avoid that from get-go, I think you have a much better chance to build a sustainable business.
Yeah, I think like 2023 is a good vintage, but there were some people that were buying into pre-IPO late stage stuff at multiples that were mirroring a stock market that was out of whack. And I'm not the smartest guy by far, and I can't predict the future economy. It's way too complicated. But I felt very confident that if SaaS multiples normally were 12 and now they're 47, most of our companies don't sell like day trading right away crypto. We hold for like 5 years in a day to get the QSBS, and that's just what happens. I'd be willing to give up QSBS if someone bought faster, but these things take years. So what are the chances that it's going to be a 47 multiple in the public market in 5 years from now or 3 years from now? I think we're in a bubble blip. And so statistically, it was very dumb to be investing at, bizarre multiples at that time when you're not going to exit within the same moment, Yeah.
It's really funny. I mean, it sounds like you have a teenager as well. It's a little bit like I try and talk to my teenager about life, and they kind of look at me like, yeah, whatever, old guy, right? And I felt like I was having those conversations a couple of years ago with founders, but having lived through 99 and then lived through 07, 08. 07, 08 didn't impact as much technology, but it was still out there. You just understand that these things don't last. But having said that, you talk to a 20 blank year old entrepreneur first time and you say, here's why you don't want to raise capital at too high a price. Yeah, whatever, old guy, like this
Yeah.
isn't going to end.
Yeah.
And these things end. They do end, and we live in cycles. And I tend to believe that we're now in a prolonged retraction, largely because of the Federal Reserve. And I'm not that smart, but I can look at 80-year charts of interest rates and the correlation to stock prices. It's just
So let's talk about that. I think what is your, and you've got an enormous, wonderful background, and that CPA stuff has almost been my favorite thing in your background, because like, unlike some people, you actually understand what retained earnings are. But
I'll tell you what, it was pretty fun as a side note with my CFO when I was a CEO, because every once in a while he would drop some of that CFO or that CPA language. I'm like, I know what that means, kind of. I still
or even
remember,
worse, he's getting it wrong. Even worse, like it's like, what did you say? Gross margin is what?
Yeah.
Well, so no one can predict. I think Marc Andreessen said it best. He said, the global economy is so complicated with so many moving parts, it is impossible for anyone. There is no great computer that can process it. But what is your sense, to answer the impossible question? Like, do you think interest rates are going to go up? Do you think property prices in Austin are going up or down over the next 6 months? Like, what's your thought?
Yeah, I think that you have to, I mean, again, I'm parroting what I hear from a lot of folks of what happened to the market and black swan and stuff. But, fundamentally, the Federal Reserve has to do something with inflation. Inflation is not, like, the thing I think it's overlooked on inflation is you cannot go pay someone who works at an entry-level job $15 an hour and then pull that back. You don't pull back wages, rarely. So once you take, if you used to pay someone at Subway $7, then it goes to 10, it goes to 15, it's really hard to go back to 7. And so I just think there's a natural wage inflation that still hasn't worked its way through the system. The only way to mitigate that is through interest rate. And I can't imagine, maybe they don't continue to raise interest rates, but they're not going to be able to move on interest rates down for 24 months, at least in my opinion, which tends to mean, to your other question, I would not want to be trying to sell a house in Austin right now, or any market. It just, the U.S. consumer, and I don't think the U.S. consumer, the average U.S. consumer, has processed the reset on all costs. So if you're buying a new car, you're buying a house, whatever you get, credit card debt, your interest rate cycle is going to impact you in a pretty negative way. And we've only just begun that set. So I don't know. I think it takes 18 to 24 months for people to go, holy cow, I'm not, I can't afford this, or I need to cut back on that. That just hasn't happened yet.
Yeah, like in a world of like fake news, getting information from your portfolio companies is actually an amazing source of information. So with your 40 companies, I'd like to hear what you're seeing there. Like one example is I have a portfolio company, Envoy America, where they're kind of Uber for the elderly. So if your mom has Alzheimer's, you're not just going to send her an Uber, but you can send her an Envoy America to take her to church or whatever. And they started taxing around COVID positive people for like kidney dialysis and things. And all of a sudden their COVID revenue, they were charging a lot more per ride for COVID than for a non-COVID. And so we had like weekly numbers of what was actually happening with COVID going up or down. And it was fascinating. With your portfolio companies, and what you have like 40, right? Or 50?
40, yeah.
Okay.
Yeah.
What are you seeing on like sales cycle times? Like sometimes it's a boom economy and people are like, all right, thank you for reaching out. We'll set a Zoom for next week. And then they're like, we're in a hiring freeze. I don't know. Let's set a call for March or April.
Yeah.
And it slows down. On the other hand, if times are tough for the enterprise buyers of this technology, they can't afford not to use technology that's going to lower their costs or increase their sales or do the job of a human 10 times better or 50 humans. What are you seeing with how rough it is?
It's interesting. We had this even before COVID. We'd always stress test it, because having been operators, we always say, what happens when in a recession? That was kind of certainly on the enterprise side, and even on the consumer. So we do some consumer. It's always like, what happens? I would say that universally what we're seeing is and this is where I think the rat going through the snake is just happening. Everyone's cutting costs. Everyone's slowing down sales cycles. Anything that's not mission critical is being pushed. And so that's, I think, happening on all of our companies selling. I think the other thing that's happening is even emerging growth companies are now looking at all their SaaS subscriptions. The average SaaS company, even $5 million company probably has 40 different SaaS subscriptions. Do we need all 40? So you're starting to see all of that move through. I would say that our most of our board season right now has been, things are going to slower, take longer, cutting costs, and now we're saying reduce burn. So all of that's happening. Yeah. And I get back to the same thing with the U.S. consumer. I'm sure your portfolio, you're seeing the same thing. It's just now starting to work its way through.
Right.
So when we're looking at projections for this year, we're saying to all of our portfolio companies, have you thought about churn? Have you thought about delays? Are we using the models from the last 2 years of sales productivity and just extrapolating forward? Or are we assuming some sort of reset? And I think that's what, again, is just starting to happen. And I don't think it's worked its way through the U.S. economy or community yet.
But if you look at like the YC company that is selling their product service offering to the YC alumni, and then the YC alumni startups were raising 25 million on 125 million pre on 1 million revenue, and then that gets corrected.
And by the way, that 25 million was going to last a year, because they were going to be able to go raise that, 500 million in 12 months.
Yeah. So the 24. So this is the point. The 25 million financing for this hypothetical company was going to last maximum 24 months, right?
Yep.
So they were going to burn through that in 24 months. God save the queen. It's going to happen. Or they were going to burn through it in 18 months, and if they can line up another financing, they could accelerate, right? Yep. So let's just call it 18 months, $25 million spent over 18 months was the plan. So what they're going to do mostly is hire people, which means more software seats for the one guy selling. So he's landing and expanding. ACV, average contract value, is growing with existing logos because they're raising a $25 million round. Now that by like October of 2021, that same company closed a $7 million round on a 32 million pre, and they're going to make 7 million last the same 18 months. And but that was still growth for the guy selling to his YC, brothers and sisters. So I think there's a whole bunch of reasons to think that the growth that we had coming out of into May of 2020, when it turned out that COVID is like the best thing to ever happen to digitization of the world, and then it flew through 2021, just hiring freezes. I was talking to First Republic Bank yesterday, and they said they have a hiring freeze at First Republic Bank.
Yeah, well, I've got a friend of mine who runs a multi-billion-dollar, still private, but private equity-backed SaaS company and software company. I said, what's the biggest change you said? He's like, no one's quitting. Like, wow. I mean, California-based. He's like, no one's quitting. So
what do you mean no one's quitting?
To see that. He was like,
so no one's quitting their job because they think I'm lucky to have this job.
Yeah, like he was saying, we normally plan for this level of attrition, and suddenly no one's quitting. So I actually think what's fascinating, if you kind of go through what happened, we all saw in 99 to 2001 is, okay, you got a bunch of software companies selling to other emerging growth companies. That's dangerous. But then start to play through, what about real estate? There's a bunch of software tools that came out for real estate, or for HR to deal with remote work or hyper growth. You've got all these categories that were built upon a 5-year plus cycle of hyper growth and easy credit and all of that suddenly changed. So you got to rework all of that. And that's where I think the fallout in the venture community, and we'll be part of it, we'll experience it as well, hasn't really hit. Then I throw in the fact that a lot of those companies raised a bunch of money 18 to 24 months ago or 12 months ago. If they're not managing a burn, that really blankets the fan here in 2023, maybe 2024.
Yeah, I think from our perspective, valuations coming down, startups tolerating real due diligence, as opposed to it's Thursday, the deal's got to close by tomorrow. I said like they're sending signature documents on DocuSign. They're not sending me answers to my questions. You know what I mean?
Yeah.
That a return to DD, lower valuations, austerity at the startup level of making 7 million do what 25 was going to do badly anyway. Don't go renting a Rolls Royce at South by Southwest. Maybe don't even go to South by if it's a waste of time. You know, like just making smarter decisions. And then talent, you know, hiring freezes at the corporates. Our startups all compete. Your startups compete to hire people that get, you know, Gwen Stefani playing while they eat a Michelin star sandwich at lunch, you know?
Yeah.
So I think that the talent is a big deal. You know,
I actually think, I mean, I take it a step further. I think that if I was an entrepreneur, back to being an entrepreneur, I'd much rather be starting a business now than I would have 4 years ago. When I started as an entrepreneur, watching, you know, Mark and Ben do it in '99 when we were, you know, the cover of Wired magazine when there was such a thing, and it was like, and you know, Ben was like, you can't hire fast enough. That was the mantra. Like, we're going to be so big, you have to. It was all scale, 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 and that was the song of the day. So I don't mean to dismiss it. Contrast when I became an entrepreneur in 2003. Holy cow, the talent
that was nuclear winter still.
Yeah, and the ability to build culture. I liken it to, you know, it's kind of like right now what's happening is like I've got kids. Like if I'd given my 10-year-old sugar for 10 years and now it's go eat your vegetables, really hard message. I'd much rather start now because to all the things you mentioned, you can build a culture. You can get people to come to want to work for you for the mission, not just for the, you know, outsized return. So I think it's going to be a little bit easier or a better time to start a business. But those who are already in the journey, yeah, it's pretty painful reset.
Well, I always have an affinity for the VC that was a founder that has done layoffs and all that. I remember my VCs demanding that I spend not less than $25,000 a month on PR to be on the cover of Wired magazine in like 1997, 1998, that period of time. And I did it for a while. Then I fired one PR firm, then I hired another. And I was like, look, we're going to learn as much as we can from these idiots and we're going to fire them and bring it in-house. And to hell with the VCs. I'm just not going to waste that money. And, you know, Ben Horowitz is kind of like, I mean, I shouldn't, well, let's not say him. A lot of VCs are like, I'm going to put nitroglycerin in the gas tank of each of my portfolio companies, push them to the motor blowing up so that 4 of them get to $1 billion. I own 25%. That's my $1 billion returned. And if it leaves dead bodies and suicides all over the streets, you know, so be it. And so I think it's good for a founder to stand up to their VC when they know 25 grand a month could be spent on some young person who all their friends work here. She's dying to work here. We can have her do what the PR firm we believe was doing or we weren't happy with. So I think it's great to really watch the spending and have compassion of not putting nitroglycerin in the tank of every one of your portfolio companies.
And I think to add to that, Andrew, it's a great point. It's like, listen, Andreessen Horowitz has built an amazing firm with phenomenal returns, as far as I can tell. So that model works. I just say to entrepreneurs, just know who you're dancing with, right? Like if that's the model and it's going to be, we're going to pour super fuel on this and it's $1 billion outcome or bust, that's fine as long as you know that's the movie. That's not the movie we play. We're a different movie, and you know they both can work. Certainly for investors, I think we're going to drive great returns. It's going to be a very different way. And so I think it's just the temptation of the entrepreneur is take the name firm, take the money, take the highest valuation. And I get why there's some real value to that, but just make sure you understand that, you know, what you're getting in return for that is going to be different. And that's what I think gets lost sometimes.
Well, so let's switch gears to starting a fund. A lot of our listeners are emerging managers or thinking about it. Like, what does the world need? 10 more million VCs? I don't know about that, but anyway, it's probably what we're going to get. So fund one. Now, your partner was at AV. So in some ways, I would put you guys in the category of spin out to some extent. How did you, but he's got an entrepreneurial background as well. How'd you raise fund one? Like, did you have an anchor LP? Did you have an anchor LP or did you just jump into the pool?
No, not to the end. I mean, it's interesting. I had this amazing, so I'd raised a bunch of capital. I was way overconfident coming into the fundraising. Admittedly, I was like, I should, no problem. And married to that, Bruce Stanley was one of the founders of Benchmark, great mentor, said, when I told him I was going to do this, just a wonderful human being, said, okay, who do you want to talk to? I don't know, Bruce, anybody, literally pulls out like the best names in the LP community. And when Bruce calls them up and says, hey, you should meet with these guys, you tend to get the meeting. So we had some real advantages. My partner had been in venture and had been an entrepreneur. I had taken a company public, and we've got this. So I went in way overconfident. And then Bruce had warned me, he said, just trust me, it's going to be a slog. Slog, come on, blah, blah, blah. It was a slog. We were aided by the fact that we put a lot of our own money in. So we were making a outsized GP commitment. We then started with family offices and people who know us to kind of get some foundation. And then we met with, I don't know how many hundreds of LPs who I would walk in with this Cambridge report. This is 2015, 16. I'd say, that first time funds that are sub $100 million, where the GPs are putting a lot of their own money in, there's like massive data that suggests they outperform.
And it's factual. It's factual. You can't argue against like gravity. But what happened?
But well, you're a new fund. You never worked together. We'll wait till fund 2 or 3. So it was literally like, and this community that we sell to, and I don't mean to dismiss them. One of my friends on the LP side said, "Listen, we're like trout in a river all day long. All day long, stuff's coming at us. We're looking for a reason to say no." Because, like if you're UTIMCO or Harvard, you're seeing thousands every day. Here's another new firm. And you're trying to manage like, hey, I've got this commitment to benchmark. I don't want to lose that. So I've got to save a spot for that. So they've got really challenging jobs that I didn't fully
But by the way,
appreciate.
Harvard told me, I had dinner with a guy from Harvard Endowment. He'd actually spun out and had like a few billion. He ran the Harvard Venture Endowment practice for a long time. He goes, he had a couple of drinks at the dinner. And he's like, look, Andrew, let me just come out and tell you the truth. You haven't even gone through generational transformation yet. This is not going to happen until that happens. And so I said, so I need to retire. And then the returns need to remain, at this 7X or whatever consistency. And then we would get, you're no longer at Harvard money. And good to I thought I was raising for fund 3 when I was raising for fund 1. Yeah. And then I was just like, well, maybe we should just they want to have dinner, but maybe we shouldn't go.
Well, the thing that I found, and I would say like my advice from my long-winded story is the flip side is these people, the LPs are always looking. So they spend a lot of time meeting. Like, listen, if an entrepreneur shows up today, I had one in the meeting beforehand. It's not a fit for us. I have no problem saying on the thing, I don't want to waste your time. Not going to be a fit for Next Coast Ventures. Go spend your time elsewhere. To me, that's like being respectful of the entrepreneur, not wasting my time, not wasting her time. Move on.
Hell yeah.
The LP community does not have that level of, in my opinion, because they're like, I don't know, well, maybe. We've spent a lot of time meeting with folks that only after the fact. I remember one meeting we met with a guy like 6 times, and finally we said, what do you think? He's like, oh, we don't have any venture allocation left. Why did you meet with me 6 times?
I think the word you're looking for is compassion. Like they don't have a level of compassion that you have compassion for the founder of saying, and also you're like, look, I don't work at Wilson Sonsini. I'm not getting paid for this either. So,
but on the flip side, they take, the flip side, they back folks like us. They're taking a huge risk, like, I don't know, partnerships blow up, so they are giving you kind of a blank check. So I get it, but it was a slog. And it's gotten a little bit easier.
And so when did so fund 1 was vintage 2015. Does that mean you were raising it in 2014?
I think it was vintage 16. So we spent, it took us about a year. So we spent most of 15 raising it and started deploying capital in 16.
That was probably good times to be raising. 2015 was kind of go. I mean, our own portfolio companies were 4Xing, 3Xing, 2Xing revenue, and the valuations were going up fast. So share price, it was just good time, back then. And what were the dynamics of going from a fund 1 to a fund 2? Was your LP base pretty much exclusively institutional?
Fund 1, it was not. Fund 2, it shifted that way. So our goal was we run in a more institutional money in fund 2, and then really fund 3, which we just raised a year ago, was when we switched over to kind of 80-20 and brought in some substantial names that had watched our performance 5 years, realized that our partnership was working, realized that we were recruiting talent, and getting great entrepreneurs. And then I wouldn't say it was easy, but it was dramatically easier. And, you know, a big check coming into a fund versus a bunch of little ones for obvious reasons is a different deal. So that was a big shift in fund 3, not fund 2.
Okay. Well, that's good. That's good to hear. It's not an easy transition to go from people that know you to closing these endowments that, you know, like I've got friends that raised a new fund to fund, and I was like, hey, you know, so is now the time? And he's like, no, Andrew, it was all warehoused. I basically had logos of people that were already in. We got bigger value allocations to them. There was like 2 or 3 that gave me a warehoused allocation. We shopped it. We got it done in time. So it was spent before it was raised, you know? And so so what you want to do is get a seat in that boat, right? And then they let them make their fortune gathering your logo among a few others, and have steady institutional, as opposed to, like, we've had people put big checks in fund 1 and 2 and 3, and then getting into fund 4, they're like, you know, I'm at the age where I shouldn't be writing $5 million checks. If anything, I should be trying to spend it. And I was like, all right, damn, I thought he was investing for his estate at this point, right? Which many are, you know, but it's tough to make that transition into institutional. So that's great to hear. And so, on closing out on the exit market, you said it's not, you wouldn't want to be selling your house in Austin or anywhere right now, on just, you know, regular real estate property. What do you think about timing on a business being sold or acquired in 2023, 2024? It'd be nice for you guys to turn some TVPI into DPI.
Yeah, I think it's gonna be equally tough. I think that the thing, depending on category, of course, but you made a great point, several great points early on when you said how many companies. Let's use Salesforce for example. Obviously, just for this week came in. I think an activist joined in that stock for the first time ever. So your Salesforce, your corporate development Salesforce, how many companies do you think are on your radar, or are you getting pitched to on a regular basis, right? And are you going to go do, and you can pick Salesforce or SAP or any of the big category leaders. There's a huge number of companies out there. You're trying to figure out if you're going to go do anything significant in terms of size. And oh, by the way, your stock price is being under pressure, and all the things that are happening in the economy to you as well. So I'm confident there's going to be some good opportunistic plays, and people are going to be able to. I think there's going to be big companies that say like, hey, you know what, I like that space, but the valuations were crazy. Maybe I'll go make a play now that they come back in line. But I think for the most part, I think it's going to be slow. I can't imagine that any of these companies have the appetite to do a bunch of deals, and there's a bunch of opportunities. So I would be highly selective. I think the private equity, the buyout funds are going to be super active, buying things that are really attractive. Whether that's private or public will be interesting to see. But the Silver Lakes, the Thoma Bravos, these guys have all, Hellman and Friedman, they've raised massive funds. Pale in comparison. I mean, you and I are playing interesting game, but when you're raising $20 to $30 billion to put to work over the next 3 years, that's pretty interesting.
Yeah, I mean, they may just kind of follow the Elon playbook. I mean, at least on the side of does Twitter need all those employees? I mean, guys like that, they have the money, they come in, the company didn't want to go through down rounds. They didn't have the heart to fire all these people that shouldn't be even in the building. And those chainsaw guys just rev up that chainsaw, they buy it, and they'll say 80%, I've done this exercise to save the company where I'm like, all right, I'm coming over. We're going to go through every single expense, starting with every person. And I'm going to say that person's fired, and you fight for why they cannot be fired. And then in the end, we'll save the company. And, it sounds rough, but it's better to save a few women and children from the Titanic than sink a boat to the bottom of the ocean with everybody in it. And then maybe you can hire some people back, or especially in the Valley, it's like these people can walk across the street and find a better job anyway. I
mean, it's like Google lays off 15,000 people, which was kind of interesting, because it was like, wow, okay, that shows you where things are. But you're a Google engineer. I saw someone guy saying, I've been in Google for 20 years. Like, well, how much money did you make?
Oh,
You're in
yeah.
Google for 20 years.
We
You
love
should have
those
made a
guys
lot
as
of money.
LPs. Yeah, I mean, like,
Yeah, exactly.
it's like you joined Microsoft in 1997 and you left last year. Let's have dinner. I'll be in Seattle. I'll meet you in Woodinville. Let's go. And then that makes for a great LP because he literally knows a lot of people. Been to Asia, Yeah. Well, listen, great talking to you today.
Yeah, thanks, Andrew.
We'll put a link to, or send me the right link for what on Amazon, or I can find it. And I look forward to seeing you soon around town.
Yeah. Thanks, Andrew. Really appreciate it.
Okay, mate. Great. Have a great day. Bye for now.
You too. Bye now.
Well, that was certainly interesting. It's Marc Andreessen with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.